This is Justin Pulitzer. This is my weekend review video for Sunday, August 28th, 2016. It is, however, being filmed on Saturday, the 27th. Keep that in mind. If any events happen on Sunday, it may throw off some of the numbers and analysis, but everyone always wants me to get the videos out early, so I am working my best to do so. So we were all on eggshells this week, waiting with bated breath for Janet Yellen's Jackson Hole speech, and her speech wound up really not being all of that interesting with regard to policy in my view. But some of the subsequent pop-offs by Vice Chair Stan Fischer and some of the others colored the market as being, I guess, the Fed being a little bit more hawkish. I'm going to try and dispel that as best I can right now. I originally was going to read off to you some of the economic reads of some of the data that we've had the last couple of weeks, but I think that'll be a little bit time-consuming, so what I'm going to do is go through these and just give a brief synopsis. If you're curious to read it, just pause the video and read it. They're blown up, so you should be able to read it fairly well. The Fed looks at a lot of economic measures. I've discussed some of the market keys and some of the Fed keys. I'm just going to go through them quickly. PMI manufacturing here was a small miss versus the consensus. You can read through this and read that the data is really not improving. In fact, it's actually getting worse. You can see that here in the PMI. Same thing with the services, really pointing to slower growth, slower orders, and so on and so forth. This was an inline number, but the internals of it you'll be able to read are showing some deterioration and weakness. Philly Fed, the Fed's own survey here, was again a meet, but showing signs of deterioration. If you want to pause and read through that. One of the things that the Fed always is worried about is inflation. You may have had a slight uptick here, but again, we're not seeing nothing that would justify the Fed to see rate hikes coming. If anything, low wage growth down here, and economic stagnation again has the risk of inflation very low. The GDP report, stall speed here, really nothing going on. Again, a very weak first half. And the Fed is again basically doubling down on red or black or whatever however you want to play it, and they're betting on a stronger second half recovery. It just doesn't seem to be coming that way. Durable goods orders were improved, but even ex-aircraft, yes, they were up modestly, but I shouldn't say modestly. There was a pretty big beat, but keep in mind this number has been sucking wind all year, and I think a lot of people just finally had to put their orders in. So a lot of this is maybe making up for the first half and really not showing that we're in a robust economy. Anyway, those are the big important ones. Obviously, this coming Friday, we're going to get a jobs claims number. Stan Fischer has obviously now highlighted that, so we're going to have another week, I believe, of concern over what that number is going to look like. I think that people are going to say if it's a hot number, then the Fed is more likely to hike, although I'll show you, even with the kind of hawkish comments of Fischer, the probability of a September rate hike are now only 33%. They had been 21%. And in December, they're still rather low, being below half. I do believe that December is a likely go point, though, for the Fed, just because they kind of can. And I think that it would be a huge embarrassment for them to not. So I do believe December is a live possibility. I don't necessarily think September is. I actually took time to read through the Fed minutes of their last meeting. I have highlighted before that the Fed is in a dovish stance. It would be highly unlikely for them to go from dovish to hawkish without first neutralizing, which they have yet to do. Yellen did say that conditions are improving and that she could see the case for a rate hike coming. However, with the data that I just showed you, it is spotty at best and really rather weak in my view. In the minutes, they highlighted that they are still below their 2% inflation target. If there's no inflation and we have stagnant growth, there is very little reason for the Fed to act. They wanted to see if jobs improved. Wages are still stagnant. The job number that everyone was so excited about after prior to were big misses. Really included more hiring in the government. There was a bit of an uptick in retail and an uptick in the coal. I should say the I guess the coal industry and so on and so forth. That area. I guess these companies were tired of having the janitors run their machines, so they finally hired a few people to handle it. That whole sector has been in huge contraction. The Fed did highlight, and I believe the reason why Stan Fischer was in kind of pop-off mode was they're concerned about a reach for yield, meaning they don't really want the market to take off. They know it's trading at a kind of I shouldn't say historically expensive, but trading at an elevated PE. When you factor in the lowness or the weakness, or I shouldn't say weakness, but the low interest rate environment, it's really not that high of a PE, but in general, it's a higher one, and I think they want to really avoid some type of a blow-off situation because the market is kind of the only thing they have going for them. We have weak employment, we have fairly weak, based on the type of quality of jobs and wage growth, not talking necessarily the total number, although I believe the total number is a lot weaker than the headline number implies, and that has been confirmed by Bernanke in past speeches as well. So it's not just a conspiracy theory, it's actual fact. So I think that's the reason why they're trying to keep things down. They also highlighted weakness in Italian banks, and I can't see how the earthquake we had this week is going to help that any bit better. The Fed, in their own words in their minutes, thought that the risk to the GDP was to the downside, the inflation risk was to the downside, and that the foreign risk was to the downside. Not mentioned in the minutes, but one that I've been watching is this situation that's developing between Ukraine and Russia. If that really pops off again, that will be a huge negative for the world economy and potentially for the markets. So all of those indicators, by the Fed's own words, were to the downside. So I don't really see where Yellen is saying things now are improving for a case. For rate hikes, I think, again, this is all just jawboning. And then Stan Fischer, I have to say, he has a long history in central banking. He's a South African guy who worked with the Israeli central bank and is now obviously Yellen's number one, the number two guy at the Fed. I think he is proven to be. He likes to play games with reporters. He likes to talk tough. I think that his jawboning is making him, to me, look quite incompetent because the data that I've just displayed and mentioned to you based on the Fed's own words and their own minutes shows anything but. So I really don't understand what he's doing. And, some of these, other than, jawboning, that's the only thing I really see here happening is jawboning. So I don't see the Fed getting super hawkish here. There is nothing in this data that would... there's no inflation risk that they see. The risk, as outlined by them, is to the downside, and the same thing with growth. And if you have stagnant growth and no inflation, there's no reason for the Fed to intervene to cool down a already cool economy. It would be kind of like pouring ice water into the Arctic. It's not quite that dramatic, but I wanted to give a good visual. Nothing here is overheating. Anyway, let's get into the markets now that we've kind of ate our vegetables. So as far as the market keys go, VIX is hovering around the lows. We're starting to make some higher lows and some higher highs. I discussed this, that we have some periods of uptick in volatility. It makes sense that around some Fed minutes that we would have, and it wound up really just closing as a big doji on Friday. So it doesn't seem to me that the true market, other than, I guess, some people, the three guys or five guys who were kicking around a hacky sack in the S&P pits in the dog days of summer on a Friday, were really all that worried. So yes, this could be a bit of an upcycle for the VIX. I am mindful of that we are kissing the lows, that there should be some volatility coming in. I do believe that the probability of a September hike will be raised. I think that it had been so far discounted out of the market that people are going to be caught off sides and that they are going to start factoring that back in. I, for the record, do not believe September will be a rate hike, although it doesn't mean that there can't be a bit of a panic that the street will start thinking that September's on the table. Most of these guys are lazy. They don't really do the actual work. They don't go through these reports. They don't go through the minutes. I did all of that. It seems very, very unlikely. And the market did interpret Yellen as being dovish until Stan Fisher opened his big fat mouth. So we'll leave it at that. I don't want to roast this guy any further, but he and the rest of the Fed heads, all other than Yellen, because Yellen in the big pressers has proven to be dovish and the voice of reason, they have all proven themselves to be incompetent. I don't know how to say that in any stronger words. I could use some four-letter words to describe them, and believe me, I would love to if this wasn't quote-unquote a family show, but they're a bunch of morons. I'm sorry. The data does not show anything that supports these hawkish type of pop-offs that they like to do regularly. Anyway, VIX in a bit of a stagnant position. The risk to me, if you had to place odds on it, you're better off betting that there will be a rise in volatility than a move to the downside. We are still in pure directional play, though, meaning long calls or long puts to play positions. A lot of people like to play the VIX directly. I do not. I have never found that to be consistently profitable. If anything, I find it to be a loser. I like to use that to play the S&P. Bit of a divergence here. We're starting to make some higher highs here. So if you want to buy some puts on the S&P as either a directional play or a hedge play, knock yourself out. Not going to dispute that. So this is going to be a little confusing to people, but I'm going to do my best to navigate some choppy waters here. The dollar had a very large outside reversal day and is now back into the range here. So what does this mean for us? A lot of people aren't currency traders, but the dollar is very relevant to the S&P. So here's the scoop on the dollar, and this is going to sound, again, counterintuitive, but it is really the reality of the situation. The higher the dollar rises, meaning go higher, the people are going to start saying that the Fed is likely to raise rates. However, the higher the dollar actually does rise, it's going to make the Fed less likely to raise rates. So what's up with that? The Fed is very conscious that they are one of the only central banks now not actually doing active quantitative easing and policy like they are in Europe and in Asia. So by that means, the Fed is sort of hawkish compared to the rest of the world. An actual rate rise would be doubling down on that kind of hawkishness. We all know the Fed is in dove mode, but I'm talking on a relative basis. The fear they have is for businesses that as the dollar rises, by the way, one of the highlights that was mentioned in some of those, I think it was in the manufacturing or the PMI service, that exports was one of the highlights of the report, and a lot of that has to do with dollar weakness. The dollar has been coming down. If the dollar starts rising, that's going to put even more pressure on that situation, and the Fed a rate hike would make the dollar strong, even stronger. So if the dollar rises, it could do the work of the Fed for them and them not actually have to rise. Anyway, for what you need to know, as the dollar rises, the traders on the floor and the people you see on TV are all going to say that the Fed is more likely to hike because of the dollar rising. But like I said, my take is that the higher the dollar rises, the less likely the Fed will actually be to pull the trigger because they'll be afraid that the dollar would explode, and that would be a disaster for them. So dollar coming up. We are making, I guess, some higher lows here. Outside days are not something you want to ignore. My thinking is that the dollar is probably going to rise a little bit. That may put a little bit of pressure on the equity markets. If we start getting above this 25.23, which was the last swing high, we may be in a bit of a correction mode. In the meantime, this may just be a sort of list higher or list lower in the market. We'll have to see. I'm going to get into the S&P in a little while and a couple of key levels that I'm watching. But this is the first time in a couple of weeks that I've, I guess, officially, although I did start to tweet that out this week, that I'm starting to see the potential here for a pullback. We'll have to see how a couple of levels handle themselves this week. TLT, would help if I could type correctly. TLT is still remaining high, although did not perform well on Friday. It had a bit of a pop and now pulling back. We're below the kind of secondary trend inside of an up channel. Would not surprise me to see if we are going to come in to get that, panic or whatever, the fear of the September hike, even how ridiculous it might be, the TLT might continue to pull back a little bit. I've been looking for a move a little bit lower into some of these fibs. It has yet to play out. We're still in range. For the first time here, we have now closed below the 50. One day does not make a trend, but if the longer we stay below the 50, I would see the path of least resistance is lower in TLT for a bit of a pullback. We could get kind of one of these, where it just kind of lists lower. To maybe retest the 100. The 100 has been support the last couple of times. So below the 50, I think keeps the 100 in play. If we get back up above the 50, it's just going to be kind of business as usual and shop. The PE multiple premium on the S&P 500 that I have said is duly justified because of the TLT remaining high, meaning yields remaining low, is still justified. It just might be a little bit less, and you might see a little bit of that kind of premium come out if this pulls back a bit. HYG. Not showing panic either. This is something the Fed looks at. The HYG has been handling better. This is the premium for high yield over the risk-free rate, which is always treasuries. This is really where the rubber meets the road. When you start getting into one of these large pullbacks, that's when you really get your more large market corrections and potential for market crashes. As long as the kind of poor credit, the kind of the junky houses on the street stay afloat and they're not underwater, things are okay. So let's keep an eye on this. If this does start pulling back into one of these, people will start getting more nervous about recession, and that will completely take the Fed off the table. The 50 has been a key level here. Until this snaps trend, though, I don't really think there's that much to worry about. It may start getting some, eyebrows raised, but until you snap trend, there's really not that much to talk about with regard to HYG, in my humble opinion. Oil. So this has risen quite dramatically. Everyone thought the world was going to end. This is was the gentle pullback. Then it got a little steeper. Basically spent some time below the 200 and then kind of rallied. Now hanging out around the 10-day moving average. So as long as oil can kind of hold 46s and the 100, let's just say the 100 MA, we'll keep it simple. That's rightfully in the 45s, high 45s. I think it's sort of okay. If we start getting below those lows and these lows here in the high 45s, then it starts getting a little bit more iffy and we might want to retest 42s. But as long as we hold 45s, 46s, the path of least resistance is higher. Anything below that 100 starts getting a little bit more iffy to my eye. XLE, same kind of business, just hanging out, chopping. You have a lot of moving average confluence below there, the 50 being the 50 and 100 being the most important. So this could maybe list lower now that we're below the 10-day a little bit, but it just to me looks like it's in consolidation mode. Where the real action to me is an Exxon, which is looking a little bit more bearish here. Exxon is the bit of the leader. Just keep in mind, we snapped the kind of the uptrend within the larger up channel. I've been looking for a pullback in Exxon. It had been down so many days that the gap down on earnings was bought. We're just still confined in that bar. This is a bit of a bear flag. We're making some kind of lower or equal highs and some higher lows, this wedge. If this were to snap, I think that it's possible we revisit some of these fibs. The ideal scenario would be for this to go on a little longer, snap, and then come back to the channel low, which would coincide with the 61.8 fib for a screaming right or right out buy, getting closer to their next earnings. Anyway, that being said, the 200 MA is right below. We have some very, very important levels from the past. 81 was an important one, but we all know 84.70 and 83 were important. You have a 200 MA roughly around there. It seems to me like the downside in Exxon won't be too cray-cray, not for a while, although I'll keep it like this. I like to keep it really, really simple. For Exxon to repair itself, it needs to get above 89.01. Anything below that 89.01 to me for the short term remains suspect. So I consider Exxon weak as long as it's below that this earnings, this kind of gap down and high of day bar. Anything below 89.01 to me remains suspect. It will not repair itself until that is fixed. So just keep in mind the risk to Exxon, in my view, here is to the downside. I am looking for that for either a put ratio to like buy some of these and to sell 2 times out of the money down here. But it is weakness that I'd be looking to buy, not eventually to play initially short, but weakness to buy. So that's my analysis on Exxon. China is, again, kind of just in chop consolidation mode, getting closer to the channel high. It didn't quite get there. It is on the old uptrend line and now on this sort of new uptrend line. So I think you can use Friday's range. Granted, it closed toward the lower end of that range, but after multiple days of pullback, if this were to snap that low, the 36.67, I think this would likely want to come back and retest the 50 MA. There was some breakout area and 35.82, and the reference low is like around that 35 area. Also, the 50 is there. So any snap here of the 20 and the trend, I think, puts this into play. If you get back up above the highs, then I think this day, this Friday range was 37.67. Then I think the channel high is in play. So I think it's a go with a break below, play to the 50 MA, a break above to the channel high. That's my view there. I've been a little bit mixed on BABA. I was bullish on it lower. I thought it would be a potential continuation to some of these highs, but said that I was a little suspicious because we were at channel high here. So BABA has been pulling back. It is still in this wedge here. It didn't break below the low of day of this bar, although we got really close here. So if you're long and you're playing long BABA, below this, you have to use this swing low as a stop. 93.12, I think would be a snap to at the very least the trend here, probably closer into the 89s. I don't know if you get the full gap fill, but it's possible. What disturbed me here this day was that this low here undercut this pullback low. Like you had this pullback low, and it rallied to a lower high and then made a lower low. That always gets me concerned. I got out on the bounce that day. The next day it was up slightly, but it plummeted after that. Again, down the next day. Now it kind of rallied. As long as it's below this sort of trend, and you need to break the trend and get back up above the 10-day, in my view. I have some alerts here. If you could get back up above 96.63, which was this day, then I think that it would be back off to the races higher. So you had this reversal bar. Anything below the 96s, in my view, is still a little iffy and suspect. You closed roughly at the low of this bar, so it kind of, on a weekly basis, kind of saved itself. The low of day that day was the 95.05. The close on Friday was 95.06. So kind of like okay, but I really need to see it break the trend line and break these two, take all of this bar back and then these highs. So if you could get back up above 96.64, I think the trade is back to the upside to re-challenge the old highs and probably to make higher highs. Anything below there, I think, is a little suspect, potentially back down to close to either the trend or the gap fill. So that's my view on BABA. I was stopped out of that trade, so I'm no longer in BABA. I might be back involved. I'll let you guys know if I am or I'm not. IBB, thank you, Hillary Clinton. The Mylan Lab CEO was... She makes sense with her reason for the raise in the EpiPen, but given the environment we're in, it to me makes no sense. I just think it's dangerous. It's rough sledding. I said everyone would be very excited about this breakout. They were. I said it would be one to take profits into because we were coming up from the bottom. It's just been choppy and now down. The 200 MA is the key. it was a look below and fail here, and Friday's low held it. So if you're long, I think you can use Friday's range as sort of Thursday and Friday's range. If you can get back up above the 2-day high, which was 89.09, I think we're back off to the races for the move to the 1.618. If we break the body of Thursday and below Friday's range, I think at the very least we'd see the 50 MA and potentially back down to the 271 to 275 area. So that's the way I think IBB should be played. Alkermes, one I'm a fan of. It's kind of below the channel here. This was a breakdown of the channel, a look back up, which failed, and now back down to the 100 MA. The 100 MA is the key. If you lose this low here, these 43s, then I think we're coming back down into the 40s and maybe the 39s. If it can correct itself and hold the 100 MA, then the trade is kind of back to the upside. But I am mindful here. You did have a channel break, a failed retest, and now back below. I'd really need to see it get back up over 47.60, which was the high of day here, and the 200 MA for the move higher. You can see the 200 rejected here. We had a couple of days above, and then it's been resistant since. So really need to see the 200 MA clear for more upside. And the 100 MA and this range low here is the must hold. If not, it could be a good, nice put ratio for a play down to 39s and 40s, where I think that area should support. Gilead really not doing very much, just hanging around these lows. These lows have been poor for a while. I was hoping here that we were going to get the repair to sell some out of the money puts into. It did not happen. It could back off again, and it could rally. I do think longer term Gilead will likely go higher, but right here there's really nothing to see, and the risk to me is that there is some type of a flush. There really hasn't been too much capitulation, in my view, in this stock. I think it needs a little bit more of a flush. Bristol Myers, I had talked about this looking like it was exhausting down here. That was the case. It did start to get a bit of a rally, although Hillary kind of put the kibosh on that, so to speak. You really need to get back up above these 2-day bounce highs. If you can do that, then I think the move is back to the upside. If not, this is probably just going to stagnate and maybe list a little bit lower. I don't know how much lower this is going to go. I mean, there is technically a gap fill down to the 54 range. These 57s are a must hold. If that is lost, I do think that this could see the 54s and maybe even the 51s. I know everyone says, oh, you know, it's down so much already. It could go, believe it or not. This range here is a must hold. If it loses the 58.07, then I think the path of least resistance is lower to the 54s. Back up above this sort of swing high, these 2-day high, and these swing highs, the 60 level. 58s and 60s, then the could want to make a play back up to the 63s and maybe even test into the gap. So that's Bristol Myers. Financials. I wanted to mention this in last week's video. I ran out of time, so I'm going to catch it quick here. Financials broke the this failed head and shoulders pattern and is now just kind of choppy. It strikes me that if the Fed was going to really raise rates, these would go a bit higher, although they might not go as high as you think. The overall trend drag of the market would probably hurt this, but it seems to me that as hawkish as everyone wanted to say Friday was, there was just a doji. It's notable to me that the doji, the low of day this day was 23.96. The breakout was 23.93, so I think you could use Friday's range as your gauge. If you get back below the low of day here, I think it's a short, probably for a move to retest the backside of the old downtrend, maybe just the gap fill to 23s. Anything above though 24.29, I think XLF is going to rally and probably get to at least 25s, and maybe re-challenge the 25, the higher 25s and maybe 26s. So Friday's range, I want to either be short below it or long above it. We'll keep it that simple. Same kind of stuff I'm seeing in the other financial stocks like Morgan Stanley. One thing to note, this was got the, let me just show you this. This got the kind of the resistance area and backed off. Yeah, so this is a key level. If you can punch back above this, I think it can continue to go a little bit higher, maybe to 33s. A break of trend here could easily get a move back down to the lower end of this distribution in the 29s. The 200 MA was a big breakout here. It's held on the bounce, so that's the key. I mean, the trend here. The 10-day kind of lines up perfectly with that. Morgan Stanley, I've said for a while, is sort of my favorite of the financials. I would be interested in buying that on the dip. I would love a retest of the 50 and the 200. I don't necessarily think we're going to get that, but it seems like Morgan Stanley is a BTD stock, although it is run into some resistance. It was overbought a little here. It's overbought a little here. I think it's due for a little bit of pullback, but one, I would be interested in buying that weakness. JP Morgan, above the trend, it had a bit of a... it's in overbought territory here. The 10-day, let me zoom in a little more. That would be a little helpful, right? If we were sort of closer. Has been an important level. Let's keep it simple. This has a range high here of 66.37. On Friday, it had a bit of a look above and kind of fell back below. 66.20 to 66.49 needs to clear there. Anything back above there, I think, can list higher to the channel high. Anything below this sort of consolidation range here, the 65.76, I think will go to the range low here of 64s and maybe even lower down to the 50 MA. So this is key. It's got to either... It's done kind of a lot of days consolidation. This looks like a bullish pattern. Anything above that area, again, you could just use, if you want to be really quick about it, you can just use Friday's range. Above the range high, I think sees channel high. Below the low, I think we'll see the range low and maybe even lower than that. Goldman Sachs, very similar type of pattern, although this has a lot of resistance coming up into the 172s. So this would be, considering, look, it came up from the bottom, got to basically the range high. This could squeeze a little bit more, but one that I would probably... It's not the strongest of the lot. I think somewhere between the 172 and the gap fill in 180 is a good right or right out short area, actually, because that's, look, where all this old support was. This will become resistance somewhere in that pocket, in my view. Goldman is not acting well. Let's get into the broad index, the SPY. So you have a big doji on Friday. We have had multiple days of consolidation. You got finally the gap fill here. The close was 216.41. The low of day here was 216.25. So this gap is now filled. I mentioned a couple of days here. You've had a couple of days of like these look above and fails with like excess. You can view the whole day as excess, but they have poor highs, and there was really not a lot of... I mean, the ranges have already been filled. These gaps have been filled here. So there's no kind of island reversal, if you'd speak. If this like opened up here and then gap below, I would think that that would be a little bit more convincing. This has just been sort of a slow listing consolidation. That being said, we'll keep it simple, stupid. Anything below Friday's low, I think we would see the 50 MA and a retest of the real breakout at 213.78, potentially down to this old high here of 212.52. That would be a pretty decent pullback off the highs. Anything above the high of day over 219.12, then I think we would see the 121s, which would be the full 1.618 Fibonacci extension to the upside. So, and potentially, if we really get crazy, you know, the market really wants to get into blow-off mode, we could see the channel high. So I'm mindful that we could be in correction mode. We did close below the 20. We are below the 10. However, we did fill the gap, and this is really was just a move back to the middle side of this range. You could even say, if you're, you know, if you want, that you could say that this might have even been another look below and fail. We've had a lot of them. We had sort of this day We had this day, and I mean, the sellers have really not been able to grab a foothold in the market. And like I said, Friday was looking bullish. I think the mistake for the bulls is that they had opened it with a gap up, and I think that it got vulnerable when Fisher started talking. It was really a summer Friday. I don't like to make too much of it, so I'm going to use this range as the key. Again, simple. Above the high is a long, below the low is a right or right out short. That's my view. So very simple with SPY. ES, some key levels to look at. Just write these down. I don't really want to go back to my ES chart here at the moment, but the Fed mini pullback low from the Fed minutes on 8/17 was 2174.75. We're below that, so I'd see the ES is a little bit vulnerable. The low on the I have a proprietary level of 2167.25. I think we closed roughly there, so it's still kind of like okay as long as we're not losing too much of that. I have a proprietary level, though, of 2184. So we're really right in ES where it needs to hold. It needs to get back up above 2184, in my view, for more upside. Anything below that 67.25 gets still more vulnerable. On the Jackson Hole day, the 2170.25 was the spike low. We closed a little bit below there, so I see the market as still being a little bit vulnerable. I guess I'm going to have to go back to that. Look, this was the spike low. We closed below there, so it kind of tried to retest, closed below VWAP. You need to get back into this range to kind of neutralize arrest the decline. Anything below there, to me, remains a little bit vulnerable. Anything below the low of day of the Fed, which is 57.5, is still more vulnerable for further liquidation break. There is a lot of, as you can see on my chart, a lot of reference areas in here, so there could be some support into this area. If that fails, we're looking back into the 40s around, that failed Turkey, overthrow, and there was a low of day in the 40s. So this 57 really needs to hold. There could be some traction a little bit lower, but it's either this holds or I think we see the 40s. Anything back up above into this Fed spike should, I think, fill up a little bit more to the upside. So those are the areas that I'm really watching as far as ES goes. Some of the other indices weren't nearly as bearish, I guess you could say, as the ES. The IWM basically held the 10-day. It might have closed right on it. Held the 20. So I would say a snap of the 20 would maybe could take you down at least to the 2158, and maybe the 50 MA, which would be in the 18s, this range low. So yeah, Friday, again, Friday's high, you want to be above, want to be long, below the low, and the 20, I think you can easily see the 20 and maybe the 18, potentially even the 17 if things get really dicey. I would like to do that with put spreads or put ratios, meaning like buy here and selling one time or two times out of the money down here. You could even spread it. You could buy one here, sell one here, and then sell a lower strike down here. That works as well. That's IWM. Qs seem to be holding up okay. Apple's been a little bit soft, but some of the other ones have been holding up. Qs actually closed positive on Friday, so it's not really that clear of a bearish picture at all. If anything, it could be construed as bullish. I'm going to talk a little bit. Also, just so you know, look at the breadth. I mean, this is anything but decisive. Friday, the NASDAQ breadth was positive, and the NYSE, even with the decline, finished barely negative. I mean, this wasn't like a complete nasty sell-off. I think this was really just a liquidation break fueled by the comments from Stan Fisher. So that's why I'm not really ready to make any, full-on bearish calls here. Again, I'll talk about Microsoft in a minute, but the Qs are still above this breakout high. So as long as this area holds, it's still okay. The low of day didn't even get a test down to there, so you could just use this range. If we start getting above there, I've said that this spike here, I think algos are suspicious. I think that when you see these things, they like to retest them. Any break here could get a little nastier down into this range. So if we start losing it, we would want to use put spreads. I think we would retest into like midway into this range here if there was something of a nastier snap. So as long as we're above 1575, I think it's okay. It's a long. Anything below there to me starts getting a little bit more iffy and 50 MA testish looking. Microsoft, just to keep in mind, it made a new 52-week high on Friday. I've said for a while I think that this is going to want to see at the very least the .com top from back in 99 2000. We're getting really close. It seems to me that that wants to get tested. That would augur well for the NASDAQ. Can use this range high. Above Friday's high to me is a long. Below the low is a little bit maybe more iffy for a pullback into, at the very least, maybe 58s. Apple has been acting like Apple would. It never makes it. It always likes to be a bit of a iffy stock. This came up from the bottom, basically got to the range high, filled the gap, and there's just been some selling since of some profit taking. There's a gap fill roughly a little bit below at 105.87. Wouldn't surprise me to see a little bit lower. This could, though, list as low as the channel low, which would be, to retest the kind of the breakout area here, which would be the 103s, 104s. Wherever the 200 MA is and the 50 MA is at the time, they might coincide. It would be a good right or right out area. So this is how I would like to play it. Anything above these 2-day highs, noticing a theme with me? So above 107.95, I think is a play back to the upside, at least to the one, I would think probably back to the 110s. Below the 2-day low could be a right or right out short for here. If you're long stock, you can buy puts or put spreads for a, the IV in Apple is very low for a hedge. Or if you want to play outright bearish, you can play for a move down to there. If it's a move above the high, you could either do it with shares or call spreads, whatever, or outright calls. The IV is low. I don't know if you'd want to spread it. You might want to buy some calls here, wait till the move up here, and then sell some out of the monies or just book the profits. So 2-day range is key. Below the low, I think there's further weakness. Above the 2-day high, I think that there will be strength. Facebook, just doing what Facebook should be doing is the chop. You had the run up and then the chop. Same thing as it usually does. A lot of relative strength on Friday. I think they're doing some stuff to monetize WhatsApp. I don't think that this is the all-time high here. I do think that we will see those 130s again at some point, but I don't know that we don't need the freak out first, like we always kind of seem to get. You have the consolidation, the freak out to trend, consolidation, freak out. This stopped on the 100 MA key level, freak out again. This was to a gap fill, so I don't know. Do we get a freak out? Maybe to the 61.8 here, the 116s. That would be possible. There's a breakout area of 120.79. 61.8 is 115.91. That is also trend, which would be amazing if there was some kind of a freak out that got the trend and the 61.8. A little too early to call that, but if there is going to be some market weakness in the next few weeks or whatever, that would be the area to either sell puts into or to buy right or right out, right, but to buy the stock right or right out. So that's my view on Facebook. I think it's just going to be just choppy for a while. I like selling out of the money strangles, meaning puts on weakness and then calls into strength, because I do think that this is going to remain choppy for a while. Amazon riding the ship. It's correcting more by time than by price. See, you had a few days down here, got basically the 10-day rejected, and then Friday basically closed at the highs. I think this stock is destined to see 833.91 at some point. Wouldn't surprise me to see this kind of just come up and ride the channel. That would be quite prophetic if it did happen. But this stock is, I've been my fingers crossed that this thing gets one of these kind of pullbacks, particularly ahead of Christmas. That would just be amazing if it got caught up in some type of a larger summer correction. Anyway, the 50 MA moves below have been unsustainable. It has really not tested for a while. If there is some type of weakness, I think somewhere between the 231.5 and the 50 MA is a good right or right out long for at the very least a day trade. Anything back up above the 773.75 should really just be off to the races for higher. So Amazon still looking bullish. Netflix starting to look a lot better. I've been saying that for the last few days or weeks or whatever. This to me was a bit of a game changer, the break of the trend. And now are we above the high? The high was 97.74. The close Friday was 97.58. So close, but no cigar. Let's keep it simple. There's a gap fill in the 98s. The 200 is kind of going to be where it broke down from. That should be some resistance. So I do think there is some more upside short term to Netflix, but it might be a little limited. We know 103.88 is resistance too. There is a larger gap fill at 108.40 that I do think it fills. I just don't know what the timetable is. Summer doesn't technically tend to be that strong for Netflix, but I'm starting to like a little bit more what I see here. I like it long as it holds 92.93, and that roughly is the 50 MA. So let's say above the 50 MA bullish, below the 50 MA bearish. That would likely come back down and retest the range low. So let's keep it that simple. Google doing what it should be doing, mild, slight back off of the high. I've been waiting to kind of long up on Google, either on a break of the trend back to the upside, or if it could do something like pull back into the pocket here. This was the old gap where it broke down from, and this was the new gap where it broke out from. It's a fairly narrow band. And you have a rising 50 MA right below it, and 200 and 100 here. So what I would be doing is if this continues to pull back on some, let's say, market weakness into that pocket, I'd be looking to sell some out-of-the-money put premium below these major market moving averages. We could even get a little bit more specific. I think the reason Google is struggling is because it came up exactly from the bottom, right up to the top, and is now pulling back. So I drew, by the way, a 1.618 Fibonacci extension, which would take Google up to 895.44. There's a channel high here. I had drawn it up just up here arbitrarily, but maybe it moves over to here. I'll take care of that at some point. But let's draw in, just for shits and giggles, a Fibonacci retracement. The 38.2 I don't always think is so playable, but look, the 50% is roughly 743 and the 61.8 is 726. So as we pull into that kind of pocketed area for the gap fill, because gap fills tend to get, are responsive, I'd be looking to sell out of the money puts below 750 strike, preferably closer or even below these Fibonacci levels, because I do think that they would hold. So have to see what the premium would be like if it came down into that pocket, 50 MA and the gap fill area. Then I would be interested. I don't necessarily know if it's going to break this low. There's really nothing to talk about with regard to this until it would break, the 785 area. It just seems to me like this is going to just chop for a while. So that's my take on Google, and that's how I would like to play Google. Tesla really not doing much. I've rolled down my call spread. I've sold so much premium against what I've owned via short puts and short calls that it's very, very little outlay at this point. It closed a little bit below the 50 MA. The 200 MA was what caught it on the earnings gap. So I'm looking for a right or right out play long off the 200 MA for Tesla. It's weird. It didn't go down on bad numbers, but it's not really going higher. It's just sort of this listing lower. I think what's happening is that the shorts are very complacent because they know there has to be a capital raise for the Solar City deal. So they're not covering, and you're not getting the kind of squeeze that you might normally get. This just seems like it's kind of listing lower. Yeah, I have I think for a month out, I have a 230, 235 call spread. Originally was 230, 240, and I added some I've closed many out of the money puts. I think I have 195s at the moment short. If we start breaking the 200 MA, I will likely close those short puts. And I might even just close the call spread and kind of pack up shop and call it a day. But right now, it's a frustrating trade that's really not doing very much at all. If we were to lose the 200, then I think we could see the 210, the channel low, or even the 205s. This area has been the big support in the past, and maybe that would set up for some sort of a larger inverse head and shoulders that later on would lead to the rally higher. Of course, it'll happen after my play expires. Anyway, that's how I'm playing it. 200 MA and above still remains a long. Anything below there is a right or right out short, or it gets a little bit more iffy. Chipotle, frustrating a lot of shorts. I don't have anything on in this trade, long or short. I really don't have much of an opinion on the stock at all, other than you now have multiple attempts in support in this region. Poor lows. It kind of looked like, again, this came down from the top, so it shouldn't surprise anyone that the low supported and it didn't just trade through. I actually was looking, and I've talked about this in past videos, to see a look below and maybe fail to sell some out of the money puts, because a lot of people wouldn't have realized that we came down from the top. This is always something I'm mindful of. Now we are closed within this bar. So as long as this 412.19, this low here, holds, Chipotle could continue to squeeze higher. Anything back below here is just, again, in the kind of chop range, and might want to retest the 50. You can see the 50 here was resistance. It broke through. It here again kind of resisted. It should theoretically be support. But 100 MA has been grim death in this stock for a while. Let's see if it can clear. If it can clear and hold the 100 MA, I think there will be a massive squeeze to the upside. Anything below the 100 MA, to me, has to remain a little bit suspect. Now we get into the kind of the cray-cray stocks, these TWLOs and ACIAs. All right, so I said that I thought TWLO would see the 2 times the range. That was basically from here to here, and then just doubling it to the top. It got a slight tick above it and has been pulling back ever since. The 10-day held here, now the 20-day held. I really am looking for a trend touch, which would hopefully coincide with the 50% fib. At that point, I would be looking to sell near-dated, out-of-the-money puts. If there's any juice, roughly between 37 and like 40, if there's juice in there, that's also the 61.8. I think that these fibs will attract buyers at the very least initially. I don't know that it'll hold longer term, but I think enough people missed this from the move to the high that there's still some people who are interested. So if this does continue to pull back, this area to me would be interesting. If this were to break trend, maybe you'd retest the highs. You know, I don't know. It's below the 10. It's holding the 20. For me, it's really going to be the fibs. If I miss it, I miss it. You know, this was a really great play. I don't like to look back to these. I sort of look at this as the you know, the Sodom and Gomorrah type of situation. You look back, you turn to stone. So if I'm going to look back and I'm going to put any capital more at risk here, it's going to be back into the fibs, just how I'm thinking. ACIA, what's going on here? There we go. This one I said would get, I thought in a couple of videos ago, I said I thought we'd see 125. We stopped 10 cents short. So a lot of people asked me, was it a short? I said, I didn't think so. I thought that it would pull back, but I thought it would kind of remain high and frustrate. It has done that. It did have a pretty sizable pullback, but it has remained high and frustrated. People, I would think, if you're short. If you're short, I would use these 3 days as a stop. Anything back above there, they may want to bring it back up to the high. I no longer have any type of interest in this play. For me, the trade is over. If this does get back to the fibs or the gap fill, that to me would be a good right or right out for at least a day trade. But I think this is just going to kind of stay high and chop for a while. Once a stock gets this high, it just tends to do that. Yeah, I'm not saying it's a long or a short. I just think it's going to just chop. I think it's going to be very choppy. I'd get interested again, like I said, near the either the trend low, the trend, or fibs. That to me is the same kind of thing as TWLO. I don't like to look back on these. You could turn to stone. Anyway, this video's gone on a while. We're at 54 minutes. Wow. If you're not following me on Twitter, my handle is @JustinPulitzer. If you're not subscribed to my YouTube channel, hit the subscribe button, the thumbs up also. Leave some comments. Your comments help me make the videos better. You'll get notifications for weekend review videos, for Periscope rebroadcasts, and some special edition videos, which I need to make some more of. Anyway, that's my story. I'm sticking to it. Friday's range. Above is a long, below is a right or right out short. Row both ways. So row your boat. Anyway, have a great rest of your weekend, and cheers.